Futures trade at the CME, and we've seen futures hit the circuit breaker a couple of times now. And everything seems to be fairly orderly, but I wanted to get a sense from you on how that compares to discussion. And no one's decided on anything, obviously, but discussion, debates on the benefits and drawbacks of, say, shutting down the stock market for a couple of days versus letting the circuit breakers kick in.
So, Scarlett, thanks for having me. But I will say a couple things about circuit breakers. Yes, they have worked very, very well. On shutting down, potentially shutting down markets, I think that could be a very large mistake. We don't know what's going to happen on pent-up demand of buying, pent-up demand of selling, and potentially with things being so fluid as it relates to a virus. This is not a financial crisis. This is a medical crisis, and this is out of the hands of people like you and I and others. We have to go after medical professionals. So I think it's really important that people have a marketplace in order to execute some of their business one way or another. One of the things that I have been proposing is, and I think it's the right thing to do, is two things. One, right now, as you referenced, the circuit breakers overnight are 5%, and then intraday they go 7%, 13%, and then 20%. I would like us keep the 5% obviously on the overnight. I think that's prudent. But intraday, I think we should limit the top end to 13% and go no more. So at 13%, you just shut down for the day. I think we have to have some different rules right now as it relates to the markets because of the uncharted waters that we're in. Also, there's other products, Scarlett, which you're aware of, which are the ETFs that are trading, and they have no obligation to stay within the barriers that the rest of us do in listed markets with the New York Stock Exchange, NASDAQ, and CME that we coordinate together and we stay open or closed. They can continue to trade. So this morning was a great example. You know, the futures are down the limit, and a very illiquid ETF is giving an indicative price of something else. So they can all of a sudden become catalysts with very little liquidity, and I think that that's wrong. They should be held to the same standards as we are as the broader markets that are being traded today. So I would hope that those are a couple of changes. And if we can damper down the volatility a little bit, Scarlett, that might help the overall market. It may not, but I tell you what, I do think what's going on right now with this volatility, we need to try anything we can to stamp it out. But you cannot just close the markets and have nowhere to transact business.
Terry, as you mentioned, this is not a classical financial crisis, and that it's first and foremost a virus and a health crisis. Do you think that the live trading of markets, the numbers we see every day, serves as some sort of catalyst in D.C. to improve the public response, whether it's on getting the health response right or getting on the economic response, because, of course, that's going to be a major part of this story?
So I think I understand your question as meaning, are the markets going to get politicians to act more swiftly because of what's going on? And if it doesn't, I don't know what they need to do, because this is not just affecting some elite people on Wall Street. This is affecting people all across our country and across our world. This has a devastating impact on 401ks and everything else that union participants and teachers and people that are invested in the market that don't even know they're invested in the market. That's critically important. So I would hope that there is a response. I mean, it doesn't need to be a Wall Street bailout, but at the same time, I think that, you know, these are different circumstances. Our government needs to act quicker. And for our Senate to leave last week and without a resolution, I think they should have worked all weekend to come up with something that they are talking about this week. So, yes, I think we're behind the eight ball on many of things, and hopefully the markets will be a catalyst to get them moving quicker.
So, Terry, I mean, when we start to talk about sort of any changes that are made or any sort of response that does come forth, do you think that there's the general mechanics of what we've been seeing in the market is, I guess, structurally healthy? And do you think that going forward, there should be any sort of major changes to the way we sort of look at this? I'm talking about beyond circuit breakers, when we talk about the margin limits and the other sort of factors that traders sort of have to rely on.
I think the market structure is just fine. As I said earlier, this is something that's unprecedented. You know, the markets have never had to deal with a crisis like this before. Yes, we've dealt with H1N1, we've dealt with some other crises as far as medically, but nowhere to this magnitude where it's global in nature like this. So I do think that the markets are operating. I would not want to jump to any conclusions other than what I outlined earlier on limits, on circuit breakers and ETFs. I think that we have plenty of time to make those discussions to see if there's anything structurally in the market that needs to be changed. But right now, I think that's kind of putting the cart before the horse.
In your observations of what we've seen over the last 2 weeks, Terry, I know there's been a lot of descriptions of indiscriminate selling. Have you seen that, and how does it compare to other instances in the past, whether it's 1987, whether it's 2008, 2009? I would like you to give me some context here, because you've seen a lot. You've seen a lot of market meltdowns. How does this time compare?
Well, again, I think it's a different version of 87. I was trading during 87 on the floor. I remember it quite well. You know, I mean, obviously I was chairman of CME in 2008, and here I am again still today. But I think indiscriminately selling because of certain things that we're unaware of. One of the things that I think is a problem, Scarlett, and it's just people have gotten complacent. You know, people have never seen a downtick they haven't liked since March of 2009. And so now you're seeing more and more people passively in the market versus actively in the market. So you get a pent-up demand for either sell stops at certain levels or entry stops at certain levels because they're not actively managing the marketplace. So I think when you say indiscriminately selling, I think what you're seeing is there's pockets of liquidity and then there's pockets of high volatility because of the way the structure of people's portfolios are today.
Terry, real quickly, we just have a few seconds. Have the Fed's
Sure.
actions from last night or the New York Fed's actions from last week, in your view, helped at least with the functioning of markets?
Absolutely. I don't see how you can say it didn't help with the functioning of the market. So I applaud their action if you're referring to the repo rates.
Yeah.
Because that has a lot to do with payroll and keeping people to make sure they get their paychecks and things of that nature, keeping liquidity in the system. I absolutely applaud what the Fed did as far as the injection into the overnight market and throughout the 3-month duration.
All right.
Because they did it from the overnight through the 3 months.